One of the big debates of the year is the impact of rising rates on the housing market, that key cornerstone of the American dream. Now, the story is one of higher borrowing costs and a shortage of homes. It is a toxic combination that has kept prices on the up. A look at the Fed funds rate and the 30-year mortgage rate over the last 50 years, and it tells the story. Now, some new dynamics are potentially at play. Investors awaiting the Fed's first rate cut, even if minutes suggest it isn't imminent. Either way, the overwhelming tone on Wall Street is that the Fed is done hiking. It comes as U.S. mortgage rates have seen their biggest four-week slide, with the 30-year fixed mortgage rate tumbling, but still well above 7.5%. Let's put it all together. We want to bring in Mark Zandi, Moody's Analytics chief economist. Mark, you're the perfect person to talk to about this because the economy is certainly tough to figure out, obviously, when you take a look at the dynamics that are at play right now within the housing market. The fact that we have seen rates at the highest levels that we have seen in decades, yet we don't see this sort of dent in housing. Where are we as we head into the new year, and what the housing market is likely going to look like within the first couple of months?
Well, I mean, housing's taking it on the chin, and particularly demand. Home sales, we got a data point, I think 2 days ago, was it? Existing home sales came in at 3.9 million annualized. I mean, that's lower than it was when we were in the middle of the pandemic shutdowns. You have to go back to like the teeth of the financial crisis to find sales that low. And that just goes to affordability. I mean, the mortgage rates at around 7.5%, combined with the high house prices, they obviously surged in the wake of the pandemic, makes it very difficult for people to afford it. They can't, and that's why sales are down. So the only way out of the box, the only way to get sales back up is mortgage rates have to come down, incomes have to continue to improve, we have to avoid a recession. And I suspect we'll have to see some house price declines at some point here. So some combination of all those three things, but that's going to take time. So I don't expect the housing market to come roaring back here, certainly not in 2024. It probably won't be until 25, 26 before we see sales levels that are more consistent with what we've enjoyed historically.
Mark, what about the commercial real estate side of the equation, though? We talked about the fact that this is going to be the next shoe to drop now for quite some time. We haven't really seen that to that degree. Is that something that's still a huge risk to the economy?
It's a threat, yeah, for sure. But you're right, Sienna. It's not been as serious, at least so far, as I think given the fears in the wake of the banking crisis back in March. I mean, prices are down. If you look at off the price for office properties or multifamily towers or retail space, they've all fallen. Depends on the property type, 5, 10, 15, 20%. But, fortunately, that has not led to a significant increase in defaults. There's been an increase in defaults on, CRE mortgage loans, but not to the degree that it's really undermining the banking system or financial system more broadly. So far, at least, the problems in the commercial real estate market are contained to the commercial real estate market. They've not bled out, and thus the macroeconomy is, continuing to digest it reasonably gracefully.
Hey, Mark, Moody's Analytics does some political forecasting based on economic factors. I imagine you're getting into that right about now. Do you feel like you understand what it's going to take for consumers to feel better about the U.S. economy and perhaps translate into higher approval ratings for President Biden? Is it all about inflation? Do they need to see actual falling prices?
Yeah, I was just had a meeting yesterday. We dusted off our election model. We, model at the state level, the electoral college level, and produce a forecast of who's going to win the election. What states are going to win, how many electoral votes are going to win, and ultimately who's going to win. We're not there yet. We just dusted it off, so we'll have to get that together over the next few weeks. Probably unveil that in January at some point in time. My sense is the problem here for the president is that, even though inflation is moderating, prices are so much higher than they were a couple, 3 years ago for most everything, but particularly for staples, necessities, food. I saw your statistic on, how much it costs to put a turkey dinner on for Thanksgiving. Gasoline, that's come back in, but it's still elevated compared to where we were pre-pandemic. And probably the most important thing, rents. I mean, people are paying a lot more in rent. And I just think that's hard for people financially to digest, and it really makes them upset. Even though they have a job, wage growth is improving. Actually, wage growth now is stronger than the rate of inflation, but there's a lot of catch up here to do. my thinking is that, as time passes and hopefully inflation continues to go south, continues to moderate, wage growth kind of hangs tough, we avoid a recession. I think that's the most likely scenario. As time passes, people will start feeling a little bit more comfortable about things, feel better about things. But, it's got to happen pretty quickly because the election obviously is approaching very fast here.
Well, putting aside recession talk for a second, there's been lots of concern in Wall Street, notwithstanding all the talk about a soft landing or even no landing, about rumblings in the financial system, and that the Fed's tightening so far, which has been considerable over the last year plus, might break something. And in your notes, you're warning about the potential for an earthquake, another earthquake in the financial system. We had the mini banking panic earlier this year. What does that look like? And as far as you can tell, we can't predict black swans, but where might that come from?
Yeah, that's the thing that really concerns me. The high rates, higher for longer, putting a lot of pressure on the banking system and the financial system more broadly. I have this image in my mind of the financial system as kind of like this engine that's shaking under the stress of the higher interest rates. It kind of blew a gasket back last March, and the Fed and Treasury kind of put the gasket back in, taped it up, but it's still shaking, and it's going to stay that way until we start to see rates come back in, the yield curve becomes more normally shaped. And so there's a lot of stress. What actually breaks? Very difficult to know. I mentioned just one thing that I'm watching that makes me nervous. It's the liquidity, so-called liquidity in the U.S. Treasury market. The Treasury market is very large. It's getting larger very quickly because of our large budget deficits and debt. But the kind of the plumbing that's involved in making sure that trading is done in a orderly way, so that there's buyers and sellers and they can match up and transact, has not been able to keep up for lots of different reasons. And I worry that at some point, we might see a freezing up of the Treasury market. And of course, that's really important for the entire financial system because everything is priced up. All the securities out there, all these stocks and bonds and everything else are priced off of U.S. Treasuries. And if trading is disrupted there, that's a problem for all markets.
Mark, is the public debt crisis here? Is this it?
We're here. It's one thing when you have very low interest rates, the pressure to do things on the fiscal side are they're much less intense. You don't have to worry about it as much because you're just not adding to your interest expense. But now that rates are up, it's a big problem because debt plus higher rates means higher interest payments. Here's a factoid for you. We're going to be paying soon more in interest expense on our debt than we do to fund our defense budget. I mean, that doesn't make any sense whatsoever. And so we've got to make some changes. And, if you look at current law, if we make no changes in tax policy or spending policy, it's just unsustainable. Our debt load is going to rise to a place where the interest rates are going to rise. The economy is going to cave under the weight of all of that. So we've got to make some changes. So I think we're here. Now, obviously, we're not going to make any changes until the other side of the next election. But hopefully, soon after the next election, we get a little bit of clarity around, what voters want, and we can make some hard choices at that point. But we're going to need to do that.
All right, great insights as always. Mark Zandi, Moody's Analytics Chief Economist, and Yahoo Finance's Rick Newman. Thank you.